Welcome back to the Wall Street Podcast. Today, we're taking a deep dive into the China Property Weekly Wrap. It's a research report released August 5th, 2025, by Goldman Sachs China Securities. The authors are Yu Wang, Shi Shu, and Kaiyan Jing. It's their Week 31 wrap-up, giving us a snapshot of China's property market.
Exactly. And this report, well, it highlights that transactions were generally stable, but there's a subtle point. Market sentiment did soften a bit.
Right, stable but maybe fragile. Let's unpack the key data first. Policy-wise, the July Politburo meeting.
It focused on implementing guidance from the Central Urban Work Conference, quality urban renewal.
Okay, but notably, no big incremental property stimulus mentioned, right? That caught people's attention.
That's right. A significant omission for the sector watchers. However, they did announce specific new urban renewal policies in Xiamen, Guizhou, and Shanghai.
Got it. And market performance, how did sales look?
New home sales volume, it was up 3% week over week. Small bump.
Okay.
But year over year, it's down 10%. That's the more telling figure, really.
Yeah.
Shows underlying weakness.
And regional differences.
Tier 1 cities and the Yangtze River Delta, they continue to outperform the broader market. Secondary transactions, though, dipped, down 4% week over week, 6% year over year.
Okay, so mixed signals there. What about sentiment indicators?
New home search activity slipped, just 1% week over week, not dramatic.
But interesting divergence you mentioned earlier between agents and homeowners.
Yes. Agents noted a marginal improvement in price expectations for secondary properties, just marginal. Homeowners, though, their expectations were largely unchanged, flat.
We'll have to explore that disconnect. And inventory.
Inventory saw a slight decline, 0.2% week over week. It's also down about 4.1% from the end of 2024.
So some reduction, but where does that leave the overall balance?
Still high. Overall inventory months stand at 25.9. That's quite a significant supply overhang still.
Okay, let's move into some deeper commentary now. The report mentioned coverage developers underperformed pretty significantly, right? Down 6% week over week against MSCI China and CSI 300.
Yes, that's substantial underperformance.
So why that big drop when transaction volumes were, as you said, broadly stable?
Well, the primary driver is really that policy signal, or the lack of one, the absence of any mention of incremental sizable property stimulus from the Politburo meeting.
So it's about expectations.
Exactly. It signals caution from Beijing. They seem to be prioritizing longer-term stability over short-term boosts, and investors react to that, recalibrating expectations. Valuations get hit.
That makes sense. Now, back to that agent versus homeowner sentiment gap. Agents slightly more optimistic on secondary prices, homeowners flat. What does that tell us about the underlying mood? Who's got the better read, maybe?
It suggests perhaps agency potential from localized policies, or maybe just minor market shifts like the Central Salesman Index rising slightly. That index reflects agent confidence, you see.
Okay.
But homeowners, they're living with the broader conditions, maybe more focused on their own equity, and they haven't shifted expectations up. It points to persistent uncertainty among actual owners.
A kind of cautious optimism from agents versus wait and see from homeowners.
Something like that, yes.
Interesting. The report also talks about valuations being at a downturn trough, PB ratios at 0.5x, big discounts to NAV. Can you explain the significance of calling it a trough?
Well, calling it a trough implies these valuation levels, like the 0.5 times price to book, are down at or even below the lows we saw in previous major downturns, think 2008, 2011, 2014.
So historically cheap.
Historically cheap, yes. Suggests assets are deeply discounted, could be value there, long term. But it also, really underscores how severe the current challenges are perceived to be by the market. Maximum pessimism, perhaps.
Right, depends on whether you believe it's truly the bottom. Okay, stepping back from finance, how do these trends impact everyday life for people in China?
Well, you see it in things like expected property completions. The report suggests a low teens year-over-year decline for July.
Fewer new homes being finished.
Correct, and that likely connects to a projected fall in home appliance sales, too. Less new housing supply, less spending on fitting out those homes. Yeah. But on the flip side, that emphasis on urban renewal could mean more visible activity in existing neighborhoods, renovations, improvements. So a shift in focus, maybe.
So as you digest all this, consider how these nuanced policy signals and differing expectations within the property market might actually be influencing your own local real estate scene, wherever you are. It impacts investment view, sure, but also the day-to-day environment. A reminder that even subtle shifts in communication can have real weight.